Most Americans are buried in car loans, credit cards, and buy now pay later plans, and they've been told all debt is bad. What if you could replace that bad debt with good debt that actually pays you every month? In this video, you'll learn how to turn high-interest consumer debt into cash-flowing rental property debt, using small down payments and smart financing strategies that work in the US market. Stick around to the end, because there's a simple 4-step game plan you can start even if you don't have a 6-figure income or a huge savings account. Bad debt is money you borrow for things that lose value and don't put cash in your pocket. In the US, common bad debts are high-interest credit card balances, personal loans, payday loans, and big car loans that stretch your budget every month. Good debt is borrowed money used to buy something that can increase your income or your net worth over time. Typical examples are mortgages on appreciating property, student loans that raise your earning potential, or business loans that grow profits, when they're used responsibly. In this video, good debt means a sensible mortgage on a rental property where the rent covers the payment and still leaves you with positive monthly cash flow. That positive cash flow is what you'll use to wipe out your bad debt faster than just throwing more of your paycheck at it. Cash flow is the money left over each month after the tenant pays rent, and you pay all expenses and the mortgage. Those expenses include property taxes, insurance, repairs, property management, HOA dues, utilities you cover, plus a reserve for big capital expenses like roofs and HVAC. Let's say you buy a rental where the market rent is $1,800 per month. If operating expenses plus reserves run 40% of rent, that's about $720. If your mortgage payment is $800, you're left with roughly $280 a month in positive cash flow. Compare that to carrying $10,000 on a credit card at 25% interest. Almost all of that minimum payment is interest, and it never sends money back to you. With a well-bought rental, your tenant is helping pay down your mortgage and giving you extra monthly cash you can aim straight at your worst debts. For U.S. investment properties, most conventional lenders want 15 to 25% down, depending on whether it's a single family or a small multifamily. That sounds big, but there are several ways to reduce the cash you need upfront or build it faster while still staying safe. One of the most powerful strategies is house hacking. Buying a duplex, triplex, or fourplex, living in one unit and renting out the others. Because you live there, you may qualify for FHA, VA, or USDA loans with down payments as low as 3.5% instead of the 15 to 25% required for pure investment loans. You can team up with another investor or a family member where one brings more of the down payment and the other handles the work, finding deals, managing contractors, overseeing tenants. You split the equity and cash flow based on a written partnership agreement, but each person comes in with a smaller amount of cash. In some U.S. markets, sellers are open to seller financing or subject to deals, where you negotiate a smaller down payment and pay the seller over time, often at flexible terms. These deals must be structured carefully with a real estate attorney, but they can dramatically lower the cash barrier if the property still cash flows well. Many buyers use side hustles, tax refunds, and high-yield savings accounts to build a dedicated down payment fund instead of parking money in low-interest checking. Others tap home equity lines of credit, HELOCs, on their primary residence to fund a rental down payment, but that adds risk and must be backed by solid cash flow numbers. A small down payment only makes sense if the deal still produces positive cash flow after realistic expenses and conservative rent estimates. If your numbers only work with optimistic rent and zero repairs, you're turning what should be good debt into bad debt in disguise. Write down every debt: credit cards, auto loans, student loans, personal loans, buy now pay later, balance, interest rate, and minimum payment. Highlight high-interest consumer debt first, like credit cards and payday-style loans, because those are the ones you want your rental cash flow attacking. Pick 1 or 2 U.S. markets where rents are strong compared to prices, and practice analyzing deals using cash flow calculators or spreadsheets. Look for properties where, using conservative rent, 5 to 10% vacancy, 35 to 50% expense ratio, and your real mortgage terms, you still get at least $200–300 a month in positive cash flow. Apply a strategy like house hacking, creative financing, or partnering to keep your down payment in the 3.5–15% range where possible, instead of 25% on every deal. Before you close, stress test the deal. Can it handle a small rent drop, a few months of vacancy, or an interest rate adjustment and still stay afloat? Once the property is rented and you're consistently seeing positive cash flow, treat that money as a debt destroyer, not lifestyle income. Use the debt avalanche method. Send extra payments to the highest interest balances first while paying minimums on the rest. Then roll that freed up cash to the next card or loan. Imagine you're paying $700 a month on credit cards and personal loans. You buy a small rental that, after all expenses and the mortgage, gives you $300 positive cash flow. Instead of spending it, you send that $300 as an extra payment on your highest interest card every month, knocking years off your payoff timeline while your tenant pays down the rental's mortgage in the background. If you're behind on payments, don't have a basic emergency fund, or your income is unstable, taking on a mortgage, even for a rental, can make things worse, not better. In that case, focus first on stabilizing your budget and building a small cash buffer before you jump into leveraged real estate deals. The key shift is this: stop borrowing for things that lose value and start borrowing only when there's a clear, conservative path to more income or net worth. When every dollar of debt has a job, either to produce cash flow, grow your skills, or build equity, you naturally filter out most bad debt decisions. So that's the formula. Understand good versus bad debt. Buy only cash-flowing U.S. rentals using smart small down payments and direct that new cash flow straight at your ugliest debts. If you want a follow-up video where an actual U.S. rental deal is broken down line by line, purchase price, down payment, closing cost, rent and returns, hit like, subscribe, and comment "good debt" so that video moves to the top of the list.